the everything bubble has now burst, and that's going to hit, as to quote the movie, everything, everywhere, all at once. It's going to hit everywhere, all at once.
We're just beginning the financial problems.
I guess my expectation for today is that they will ratify market expectations because it's already built into the market. So this idea that tightening 25 basis points is going to suddenly cause a lot of other banks to be derailed strikes me as incorrect. And they also don't want to create the sense of panic. If they stop right now, people might say, gee, what does the Fed see behind the curtain that, we're not all aware of? So I do expect we'll get 25. However, I think that we're going to be looking at much more rapid rate cuts than the market is presently expected. They've built in about 50 basis points of cuts between now and year end. And I think, honestly, what we're seeing here, Maria, is not just a banking sector issue. The everything bubble has now burst. And that's going to hit, as, to quote the movie, everything, everywhere, all at once. So we're going to not have this just contained to the banking system. We're going to have corporate credit markets start to get a little dysfunctional, and municipal markets. Everything is going to get hit by this delayed impact of the rate hikes. So I do expect the Fed will have a dramatic U-turn in policy over the next few months as that happens. I mean, it's sort of the obvious weakest link in the chain because obviously the real estate market is the first thing to get hit when the Fed starts raising rates. And to Art's point, we've been watching this for decades now. The Fed basically has us ping-ponging from asset bubble to bust, and they seem to attempt to solve every asset bubble bust by pumping more money into the economy, encouraging people to lever up. And then when they inflate a bubble that seems to be only invisible to them only, they ratchet up rates and burst it again. And we're back, it's lather, rinse, repeat. So it's not surprising that we're seeing real issues with commercial real estate. And I think that obviously is going to continue and intensify. And then as you and I have talked about at length, Maria, I think that we're also going to look at some real issues in the corporate credit market as the zombie companies that at the end of the day were sort of clients of SVB, they were the customers, these companies that have been completely levered up, as they go bye-bye. So at this, like I said, it's going to hit everywhere all at once. So it's not going to be confined to real estate. It's not going to be confined to the banks. It's not going to be confined to corporate credit. This is really like 2007, 2008. All over again, except I think it's going to devolve even faster than it did then because of the speed and magnitude of the Fed's rate hike. I mean, it's just math. If you take an economy that's toting much more leverage than it was in 2008, and then you ratchet up rates in record fashion, you're going to create real dislocations with people who can't service debt at those higher interest rates. And that applies to an enormous swath of the economy, from the commercial real estate sector to certain low-end consumer distress. We're already seeing in autos and credit cards, and of course, the corporate market, which I think is the one thing no one's focused on. Credit spreads have barely budged in the face of all of this. So I think there's a lot of ugly stuff coming down the pike, unfortunately.
I do think that Stephanie's correct about the Fed just following a very small increase today. But I don't think it makes much difference. To be honest with you, the Fed shouldn't be determining interest rates. They should be following the markets, not leading the markets. And this is what got us into all the problems we're in today. And the use of credit facilities, the banks, Silicon Valley, all of that is a direct consequence of Fed's being aggressive action of trying to control markets rather than following markets. And it's a major mistake, and I hope they change it. I think there's a serious problem of the financial institutions because of the Fed policies and also because of fiscal policy. What Biden's budget and the proposal of tax increases does not make anything better. But I think there are a lot of cracks in the system, and I think we're just beginning the financial problems, because you're going to see this pop up in all sorts of other areas because of leverage and because of a very sharp rise in interest rates, which means that institutions' portfolio holdings of assets are at low rates because they bought them a while ago, and their liabilities are at very high rates because they're current liabilities, and that type of flip puts financial institutions right on their back, and we will see more problems, I'm guessing, over the next 3 or 4 or 5 months. I think that, by the way, will determine how the Fed responds for the rest of the year. I think the current estimates of how the Fed's going to lower rates or raise rates is way off mark. They're going to respond to crises as they come along over the next 9 months. You know, you say the Fed's pushing the boat and stuff, and when you look at the members of the Fed board, you don't have a Paul Volcker in there, you don't have an Alan Greenspan, you don't have a McChesney Martin, you don't have any of the people of this sort of gravitas in there, so they don't even know which way the boat's going or how to make it row. They're just responding to current crises, and you know, that's not the way to run monetary policy. What you want to do on monetary policy is do the best you can to ascertain a stable valued currency over a long period of time.
Yeah.
You shouldn't be in there responding to crises this day and next day and the next. That's not the way you should do it. Just stable prices over a long period of time and let markets clear themselves. But that is not this Fed. They are very interventionist, and they all think they can cure every week's problem by another new policy. Well, that you can see what's happening. It's not working.
I expect a meaningful sell-off. I think last year was sort of a taste of things to come. I think we could easily see a 30% decline in the market. You know, earnings estimates continue to be pie in the sky. The forecast for this year, I think, is down 2%, which that would be the first time in history we've ever escaped with that minor decrease in earnings. And the amazing thing, Maria, and I had to check this like 5 times, but last Friday when they did the update of analysts' earnings forecast, it reflected an increase in the estimate for the financial sector, which they took up from somewhere around 8% to 9.5% for this year. I don't know what is going on there, but they're clearly areas where expectations for earnings growth are so far out of touch with the likely reality. So this market has a lot of work to do, and the idea that the Fed pivot is going to, you know, be enough to put floor under asset prices is laughable to me, because we are so deep in it. We're going to need not just a pivot, we're going to need to take rates back down to where they were before the Fed started. But to Art's point, you know, one solution would be to cut regulation, cut taxes, you know, have pro-growth fiscal stimulus rather than all this ESG nonsense that's got us in this situation.
Unfortunately.